All right. Well, it's 1:05. I feel like most people who are going to join have probably already popped in. So why don't we go ahead and get things rolling? And because it looks like it's a smaller group this time, I'm just going to everybody will leave the microphone on, and we can make this as interactive as you would like. If you have any questions, please feel free to interrupt at any point, and we'll be happy to address them as we move through. Otherwise, we're also happy to take questions at the end. All right, great. And all right, without further ado, why don't we go ahead and get going? So today we're going to cover the year-end process as well as our normal investment review for the third quarter. So year-end process, if you've been running your 401k for a little bit, you're probably fairly familiar with this. It's a data collection exercise more than anything else. So what data do we really need to collect? And what do we need it for? I'll start with the second question. The main things that we need it for are for the Form 5500 filing. So that's that form that gets filed every year that lets the Department of Labor and IRS know what the plan is all about, what assets are in there, who's paying what contributions were made, things like that. And then, of course, all the basic contact information for the plan. So we'll send out a survey for that sort of information. We also need to collect data for non-discrimination testing. And I'll touch on that in a little bit more detail in a second. But at a high level, it's just making sure that your plan does not benefit highly compensated employees or key employees more than other participants. And last but not least, we'll talk about profit sharing and match calculations. So this is the last bit of data. If you do want to do a discretionary match, or if you want to have any sort of profit sharing go into the plan, it's right at the end of the year where you want to have those discussions, set aside some of that those assets that would flow into the plan, and determine who gets what. And how does ForUsAll help you with all these? Well, on the Form 5500 information, we help you gather that, we verify it, and we work with the record keeper then to prepare the form, make sure that everything looks right, and then, assuming that we don't have any questions, we'll sign it on your behalf, taking on that liability and for any sort of compliance issues that happen with the plan. That's the signer of the 5500 is the first person that any sort of audit would go to start collecting information from the plan, and it's the person who's held responsible for any compliance failure. So we're happy to take that on your behalf. Next thing that we'll do, we'll also help collect information on behalf of the record keeper for information about your key employees and your highly compensated employees so that we can help them run that non-discrimination testing as smoothly as possible. And then last but not least, we're happy to be involved as you want us to be in any discussions about profit sharing, about discretionary match, about how to structure either of those to best accomplish your goals for any additional funds that you want to put into the plan at the end of the year.
And I think just on that last point, the end of the year is a great time to take stock and reassess what the company wants to do and to see if there are any opportunities for maybe some of the key execs or some of the owners to significantly defer more than the standard IRS limits via the profit sharing plans. And so usually towards the end of the year, I know we're all busy hitting our numbers towards making sure that the business is in a great place for the end of the calendar year. And when we come back in January, oftentimes people have a little bit more breathing room, and that's usually when we begin to engage with our clients to see if it might make sense for us to work with your accountant to run some analyses that Taylor mentioned to help more people to pay less in taxes.
That's right. All right. And then, let's see, there we go. So in just a quick refresher on what we're optimizing for when we collect that sort of information. So what we want to know, and what the Department of Labor wants to know, really, the IRS, is who is benefiting from the 401k plan. Is it just the highly compensated employees, or is everybody benefiting? So what they collect is information on who is a highly compensated employee. So for that, they need salary information, and they need ownership information. And same thing applies, but with a slightly different definition for key employees. And and each of those definitions apply to different tests. The HCEs, those highly compensated employees, you'll hear me use that acronym, so sorry for the jargon. The HCEs are, what we're looking at there is their average deferral rates compared to the deferral rates for non-highly compensated employees, as well as the total amount of funding that's going into the plan for highly compensated employees, including employer dollars. So it's not just how much are individual employees contributing, it's also how much are employers contributing to the plan to run that, what's called the average contribution and average deferral test. And then the key employees are really there for the top-heavy testing. So there, what they're looking at is, over time, are the assets in the plan accumulating mostly towards the highly compensated employees, or in this case, they actually use that different definition, key employees. And often that grabs owners and family members of owners into the plan as well. That's the only real distinction there, other than the different salary amounts as well. I'm going to pause there real quick. Any questions on that? All right. Put folks back on mute then. We'll keep on going. So again, what does ForUsAll do for you when it comes to each of those three areas? First, especially on the profit sharing side, first, we help you calculate the discretionary match amounts and how much you would need to put aside for a given match. In addition, we can help you maximize the profit sharing that you would put into the plan. So either one of those, we're happy to help you with those calculations. And then, of course, we're happy to have one-on-one sessions to guide you through that profit sharing process and work with you to best accomplish your goals, whether that is to defer more pre-tax for your key executives, to reward a given subset of employees, or just to reward all employees at your company for a really strong year. We're happy to help you whatever goal you want to accomplish there. And then, if there is any corrective action that needs to be taken, if your plan has failed one of this non-discrimination test, we're happy to fix that problem for you and walk you through the steps that need to happen to get it back in alignment. And our calendar looks something like this. In December, you should expect a survey to come from our team that asks all those Form 5500 questions, as well as questions about those HCEs and key employees. And then we'll want to confirm all details of your plan census, your last year, total compensation. All of that needs to be confirmed by early January. And from there, we should have pretty much everything that we need to run the test and to make sure we're in a good place to get non-discrimination testing done by the deadlines. And that would be March 15th is really that deadline that we're shooting for. Otherwise, in that intervening period, that's where we can continue to help out with what additional profit sharing you might be able to put in, and talk through exactly how that would work. That's pretty much it. I'll pause again for any questions on the timeline that we might have. Otherwise, we can jump to the fun investment related stuff. One only last thing to bring up, you'll see a number of notices and disclosures that we're going to send out towards the end of the year. This is just to keep everything in compliance. So that should happen in November, next few weeks.
Yeah, so, and to be clear, for those of you who had plans before you came here, this was stuff that you used to have to send out in November. This is your first year with us. Don't worry about it. We've got you covered. We're going to be sending out all of those notices and disclosures and document in the digital record that everything was sent out and everything was very well.
Thank you.
So unless there are any, I have to imagine that it's not that the year-end testing data was not exhilarating. I have to imagine that they kept their questions to a minimum because you guys were excited about the quarterly investment return, which certainly I was, because it was a really good quarter. And so, we're going to leave everybody's mics on, so feel free to just dive in at any point with questions. But it's hard not to be happy after a quarter like this. Across the board, everything was just up. Starting off with the U.S., we had a strong performance of U.S. stocks, international economies. The international developed economies did better. That's in the CI-EFA. And then the emerging markets posted the strongest returns. So stocks, global equities across the board way up. Bond returns similarly positive. Bonds are not always as exciting as stocks. So you just have to, I guess, with the U.S. bonds and the emerging markets, you just shift the period one over. But we've got even U.S. bonds were up almost 1%. And the global bond markets, they were also up. And this is surprising because, as you all know, we've gone 3 quarters of consecutive interest rate increases from the Fed. And I think we'll talk a little bit about why we keep seeing positive performance on bonds, even though interest rates are increasing. And usually, when interest rates creep up, you see bond performance decline. But this is I think if you guys remember from last quarter, it was the same sort of story. Interest rates were going up slightly in a measured pace, but bond returns remained strong. And so across the board, everything was really looking good last quarter in the major indices. And the story behind a lot of this really comes down to a couple of key takeaways. Across the globe, a lot of the positive equity returns were based on what people refer to as kind of like a Goldilocks environment. It's not too hot, it's not too cold. We had stable expansion in developed economies, emerging economies. There was relatively stable inflation really around the world. Positive earnings releases, no scary bond defaults happening as we've seen in years past. And I think that overall environment just really created a very stable environment for people to be taking on a little bit more risk. And by taking on a little bit more risk, they're investing more in equities and stocks, and they're also investing more not only in government bonds, but corporate bonds. And that's one of the reasons why we saw bond performance staying strong. So the Lehman Aggregate Bond Index contains both government bonds and also corporate bonds. And when the market overall is feeling pretty bullish and things are relatively stable, then people tend to invest more in stocks and corporate bonds. And when people put more money in corporate bonds, it drives down the corporate credit spreads, which is one of the reasons why we saw continued positive bond performance, even though we've continued to have interest rate declines.
So is it fair to say that a lot of this performance is driven by folks moving out of super safe assets like cash and money markets?
I think that's right. Yeah, cash, money markets, and maybe short-term U.S. Treasuries.
Okay.
And all of that has, and moving it into riskier assets. And that's just because people are feeling pretty bullish given the relative stability that we've had in both credit and markets and in many political environments, which might be surprising because we had another quarter of some fun developments in the political world. So this is all against the backdrop of, every once in a while, we've got a flare up in North Korea. There's certainly a lot of excitement domestically here in our own political environment. But all that aside, I think that people are taking solace in the relative stability of how the capital markets are reacting to everything. And even when we look at our own Fed, even our own Fed is being very stable. So we had, you may have noticed at the last Fed meeting, they decided not to increase rates by a quarter point. That the previous 3 meetings, they had increased rates by a quarter point. They did, however, signal that there might be one more quarter point increase towards the end of this year. And they're generally signaling that there might be 2 quarter point increases next year, which, again, that's the Fed's way of signaling that they're relatively cautiously optimistic about the state of the global financial markets and here at home. The Fed has also announced in October, this was kind of big news for us bond geeks, that they're going to start unwinding, slowly, cautiously, prudently unwinding a lot of the asset purchases they had made in 2008 and 2009. So of those of you who don't remember, the U.S. government stepped into markets and started buying up a lot of fixed income securities as a way to provide more liquidity to the market. And that was commonly referred to as quantitative easing. It's now getting to the point where they're going to start selling some of those assets off. And in combination with the adjustments to the Fed rate, all else equal, that should result in some hopefully stable and predictable increase in overall interest rates as we go forward.
And when the Fed sells those securities, does that mean that will that have a similar effect as raising interest rates?
That there's a big debate around that. And so some people say yes, some people say no. I think it all matters. And I know Paul Krugman, for once, referred to a lot of these sorts of interventions as it could be just very unexciting, or in the case of developed or emerging economies in the past, he said, if not done tactfully, you get into what he calls a Wile E. Coyote moment, which is everything seems stable, and then all of a sudden the floor drops out. I think Paul Krugman would also say that here in the U.S. we have a ridiculously stable Fed, and so they have not historically been capricious or unpredictable, and so I think by signaling that they're going to begin to unwind some of their positions, that's just their way of being very slow, cautious, and prudent, so as not to spook the markets.
Okay, great.
One last thing here in the U.S. The 2 big things that was positive for us was strong macroeconomic data. So we saw overall growth of 3.1% over the quarter, and robust earnings, and a lot of which was fueled by a slow, steady decline in the dollar relative to other currencies. And for companies here, as a lot of our clients are, that are manufacturers, or otherwise generate a lot of their revenue from sales of goods and services to other countries, a continued weakness of the dollar is actually a great thing. It basically allows us to provide more goods and services at a discount without us having to actually lower our prices. So that was why we saw such a great positive environment across the board. Let me pause there for a second. Are there any thoughts, questions about the overall economic performance last quarter?
Yep.
All right. Well, let's move on then and take a look at how the investments did in our own portfolio. So we always start to see how things shook out. And again, this has been holding pretty consistent. About 3 out of 4, when we look at the assets across our entire book of business, about 75% of all assets are held in an age-appropriate target date fund. That's amazing, because that means 75% of the assets are in an age-appropriate diversified portfolio that's going to be automatically managed, that you all get a safe harbor from the Department of Labor. So both for fiduciary reasons, for us and you, as well as the just employees, everybody's benefiting when they're in diversified, low-cost, age-appropriate portfolios.
So you know for sure that folks in those are pretty well taken care of. But on the other side, folks can choose some investment for their own, still be in good shape.
And we see about a quarter of all assets are being managed independently. And what's interesting is when we look at by participant account, it's much closer to 90% of employees choose a target date fund. So that 0.25% of the assets are in individually managed portfolios. That tells us that it tends to be the higher balance employee, oftentimes the older employee, with maybe a little bit more investing experience. They may feel a little bit more comfortable. Those are the ones that are creating their own portfolios. So we always want to know. I know that these blue portfolios over here are looking great, but what are people doing in this other 25%? And it looks pretty good, actually. Here you see what overall is a very diversified portfolio that's roughly in proportion to what you would expect for somebody in their late 40s to early 50s. You have about 85% stock exposure, 15% in bonds. When you look at the stock allocation, it's diversified. You have the largest segment representing the S&P 500 index. Then you have mid-cap, small cap, and then of course you have international and the total stock index, all represented. And on the bond side, you see almost an equal split between the short-term bond fund and the total bond market index fund. And so the short-term bond fund has a much shorter duration, so they tend to hold bonds that on average are going to be paying out cash in a little over 2 years. The total bond market index, that's a little bit older or longer duration bonds that are around the 4 to 5 year range. So that's what we saw across the board in terms of the overall investment allocation. So employees in target date funds, check, looks great. In aggregate, the employees that are managing their own money appears to be creating portfolios that are diversified at a relatively good risk level given the average age for those employees. So that's what we see in the allocations. Any thoughts or questions on that? Okay. All right. You could also add in any questions you have in the chat if that's easier for you. So let's move on to see how those funds performed. And again, for those of you who've gone to past quarterly performance reviews, this is going to be maybe one of the most unexciting investment performance stories you're ever going to hear, and because it's the same story each and every quarter. Over the short term, most of the funds here, it's going to be a 50-50 flip. Sometimes they're going to outperform the median fund. Other times they're going to underperform the median fund. It really is just a coin flip. But when we start looking at the 3, the 5, and the 10-year, that's when we tend to see the Vanguard funds outperform and pull away from the median fund. And that's just because of 2 reasons. They charge a lot less in fees, and every dollar you don't pay in fees is a dollar of extra performance that your employees get to keep. And then secondly, they're not taking as many of the active bets that the median funds are. And when you take active bets, that's why I said it's a coin flip. Over the short run, sometimes half the time they'll work, half the time they won't. Over the long term, that necessarily adds additional volatility to your returns that is a drag on your long-term cumulative return.
There's a transaction cost associated with each of those bets, right?
That's correct, which just adds to the expenses, both implicit and explicit, of the investments. Okay. So let's look at what we see. We look at the large cap. Well, so they were up over the last quarter, but then really pulled ahead over the 5 and the 10-year. And this is actually pretty sizable difference, a little over 1% a year. We then move to the mid-cap equity fund. Same story, slight overperformance over the last quarter, significantly outperforming over the 5 and the 10-year mark. We jump to the small cap equity. Here they tended to be a little bit lower over the last quarter, but again, they're pulling ahead over the 5 and the 10-year. International equity, a little bit more mixed. So overall, good on the quarter, a little bit down by about not quite 0.5% over the 5-year, but they edge out over the 10-year. Total bond, pretty much neck and neck across the board. And the short-term bond, same sort of story, neck and neck with a just very slight eking out over the 10-year. The bond funds tend to be a lot more consistent when you're looking at the median and the overall index return relative to the equity. It seems that equity managers tend to take a lot bigger bets and a lot more volatility, so their bets pay off oftentimes either really big or really poorly.
You don't get as much choice in the bond world, right? Especially on the short-term ones.
That's right. That's right. And so they tend to be much more in line. So now let's take a look at the target date funds. Target date funds across the board on the for the last quarter, and these are for each age maturity. The Vanguard funds eked out a little bit ahead, except for the 2015 date target date fund. They're just slightly behind. But then we look at the quarter, or the 5-year return rather, and then the 10-year return, and they really begin to pull ahead.
Yeah. And again, this is where about 85% or 75% of the assets are. Is that right?
That's right.
Yeah.
Or 90% of your employees.
Right.
So that's the quick overview of the returns for the market and the investments for the last quarter.
So we'll pause again. Any questions anybody have?
Okay. Fantastic. What about, this is also the time where love to throw out a really open-ended question on, is there anything that we could be doing better, either for you as the employer, potentially for employees? How as a company could we be serving you or your employees better? All right.
Well, if you don't have feedback now, no problem. We're always happy to pick up the phone, have a chat. If there ever is anything that we can do for you, even if you think it's above and beyond, we're more than happy to help you out. So just give us a call. It's 844-401-CAKE, and we're always happy to chat. Great. With that, I think that concludes our Q3 investor update.
Perfect. And as always, if you want to set up a follow-up call where we talk one-on-one, just let us know. Love to connect. All right. Thank you so much.
Thanks so much for joining. Bye.